Welcome to Investors Insights. Our topic today, these checklists don't lie. My name is Greg Powell, President and CEO of Five Plan Partners, and I'm honored to be joined by my distinguished colleagues, Bobby Norman, Trey Booth, and Tom Miller. All of us are on the Portfolio Strategies team here at Five Plan Partners, and we like to communicate what we're seeing in the markets, what we think we need to navigate through. And today we're going to take you behind the curtain and share with you our insight as well as checklists that we use as we're looking at economic and market scenarios that tie back to our clients' financial blueprints. So with that, I want to start off with Bobby Norman. Bobby, in our meeting this morning, great presentation. You really brought up the whole checklist scenario. And so walk us through the recession checklist. Are we going into a recession? How do things look right now?
Yeah, so, with the amount of news and noise surrounding an economic slowdown due to the government shutdown and consumer spending slowing down, I thought it'd be a good time to show this updated recession checklist that we as a portfolio team look at every week. And so this checklist that you see helps us track leading economic indicators that signal whether an economy might be entering or already in a recession. And so one way to think of it like a diagnostic tool. It helps us evaluate the health of the economy across multiple areas like GDP, jobs, confidence. And when it starts flashing warning lights, it tells us the economy might be slowing down. So as you can see in the chart, currently 3 out of the 8 items we look at are currently checked. And those 3 are housing, which we've seen permits losing momentum as rates have remained elevated. And it'll be interesting to see how housing comes in with lower rates in the next couple of weeks. And we would expect to see a bump higher in permits. The second checked item is consumer expectations, which has obviously taken a big hit with the government shutdown and also stubborn inflation. And the third checked item there is manufacturing, which has been hurt by all the tariff uncertainty. So we do think that as the tariff deals get worked out, that manufacturing will not be on the checklist for much longer. So right now, 3 of the 8 leading economic indicators we look at are checked. And it's something that we will continue to watch as we get through a government shutdown. We work out the trade deals. But on the bright side, something we talk about all the time, corporate earnings continue to come in positive, which is a key driver of equity prices. So we'll keep you updated on that recession checklist.
Yeah, and not only will we keep you updated through these vlogs, but also through all our social media, LinkedIn, Twitter, Facebook, our podcast, YouTube. We are now on Instagram as well. We do these things not to be entertaining. We do them to be informative, to keep everybody updated. So, folks, we like to give you information and knowledge so that you understand what's going on. And with that, Trey, there's other checklists. With the Fed, we have procedures and checklists that we go through to see what the Fed's doing. I think we have a big week. The Fed's going to meet, and you brought that up and did an outstanding job in our meeting. Talk about that.
Yeah, thanks, Greg. I hope that the Fed is checking Bobby's checklist as well about where the economy is. I'm sure they do. They've got a lot of economists there. I hope they have their own. But what we're looking at is not just what the Fed's going to do. So the Fed meets this week. It's really not being covered that much, which is concerning because usually it's the things you're not watching that surprise you. People talk about bubbles and they talk about recession. The more something's talked about, the less likely it's going to happen. So a little concerned they're not when markets aren't looking at it. But we expect a 25 basis point rate cut from the Federal Reserve. And when we're looking at what the Fed does, it's not necessarily what they do, it's what the market does after that. What's the follow through? That's what our checklist really focuses on. Okay, now that the Fed's cut rates, what happens next? And let me show you on this chart here. This shows areas we're looking at. The blue line here is the Fed funds rate. The purple line is the 30-year fixed mortgage average across the country. And the orange line is the 10-year Treasury yield. So those are really important points there. And this chart normalizes those. So what this is showing is the percentage of those interest rates off their highs, going back to beginning of September before the last Fed rate cut. And what's good to see is all 3 are down. So why is that important? Why is that on our checklist? Because last year the Fed cut rates and long-term interest rates went up, not down. And so that's important because the Fed sits in between borrowers and savers. What the Fed effectively does is it puts a price on time. And so what it's doing is how much are savers getting on their savings? And then how much do borrowers have to pay to borrow those savings? What happened last year is the Federal Reserve cut interest rates, which hurt savers. Clients, our clients included, people that have built up a lot of savings, have them in money markets, cash accounts, short-term bonds, conservative investments. Interest rates on those came down. But the knock-on positive effect should be longer-term rates for borrowers comes down too. That didn't happen last year. We hurt the savers without having that follow through of helping borrowers. This year, we're looking at that. So far, interest rates have come down on the short end, hurting savers. We've also seen interest rates come down on the long end. The 30-year mortgage went from 6.26% down to 6.03%. 10-year Treasury went from 4.23 to 4.01. So not big moves, but moves in the right direction. So what we need to see post this Fed rate hike is we need to check that box that there's more follow through. We need to see continued drawdown in that 30-year mortgage so that the Fed cutting rates doesn't just harm savers, it also helps borrowers. And borrowers are the ones borrowing to buy a house, borrowing to start a new business. They're the ones that can be the engines of growth. And so we really need to see that flow through to help the economy get through that potential increase in checklist that Bobby was talking about. So very important week for us to watch and where this follow through is on the Fed.
Well said. And to our viewers, I just want to say this. I thought Trey did an outstanding job here breaking it down. And just know we'll continue to talk about that and the watching interest rates and the Fed moves here. And I also say this in our previous vlogs, just like government shutdown. We talked about government shutdown and the impact it might possibly have. And people started asking us, will it bring a recession? Bobby's addressing that. People all year long, we've talked about interest rates and looking ahead. And you've done a great job, Trey, on keeping up with the Fed to let people know this is where we think we're going. No guarantees by any means, but that's outstanding insight. And then Ty, you've also talked about some of these same topics, but also another one that our clients have worried about is deficit. That's a topic that continues to pop up in our conversations and meetings with clients. So in regards to checklist or looking at deficits, talk about that.
Yeah, so kind of want to go over the finances of the government overall. And of course, one thing that comes up in conversation, as you alluded to, is the federal deficit or the federal budget. What is that looking like? And so, unlike most of us, the government's year does not end on December 31st. Their fiscal year ends on September 30th. So about a month ago, we have the numbers, kind of rolling in now. The federal deficit right now is still, 1.775 trillion, a huge number that everyone memorizes, it seems like, and they have the calculators that show it grows every day. But, good news is it's 41 billion smaller than the deficit the prior year and 34 billion smaller than what we were expecting just a few weeks ago. And we are in the camp that this should improve in the couple of years to come as we get some new tax changes put in place and things like that. Overall, it's a minor step. It's still, not something that, I didn't say we reduced it by $1 trillion today, but overall minor steps are being taken, which is nice to see. And then, additionally, to Trey's point with the Federal Reserve meeting this week, we're not only looking at their call on interest rates, but we're looking to see if they are going to end quantitative tightening. Now, quantitative tightening is essentially just the Fed. They have this big balance sheet, what we would call an abundant reserve balance sheet when it gets to a certain level. And as these bonds mature, instead of taking that money and reinvesting them, they're kind of just letting the bonds fall off, reducing their balance sheet and going to a ample reserve policy, as you can see in this chart. That's been important to see, and it's going to be important to know if they are going to indeed reduce quantitative tightening. If they do, that should provide some more liquidity for us, which is, Trey's alluded to multiple times, typically good for the market and a very high correlation to equity returns. But we don't only want to see, like I said, interest rate call. We want to see what they're talking about on their balance sheet and quantitative tightening overall as we head into Q4 and then head into 2026.
Yes. Yeah. And we will continue to watch that. And let's talk about that. This is the last week of October, October 31st. This Friday is Halloween. Think about that. 60 days after that, we will be celebrating New Year's Eve. We will be going into the 2026 year. This coming Saturday will be November 1st. 60 days. We're not only looking now as to how we end the 2025 year and the possibilities, the what ifs, what we need to navigate through the markets, but we're looking ahead as well as we go into 2026. We hope you have a great week. We hope you're excited about the next 60 days with holidays and everything coming towards us. And in addition to that, just know that we greatly appreciate those of you, our viewers, who are clients of ours, who not only believe in us and put trust in us here with your money and your financial future, but also how you have shared these vlogs with others to encourage them to learn, to gain knowledge, and you've opened up doors for us. With that said, every day we walk in this building, our team at Five Plan Partners is striving to see to it that our clients have a better, richer, fuller life. Have a great week, and we look forward to talking to you soon. Thanks.